What's up, guys? Welcome back to the channel. Today I'm breaking down something that can literally change the way you trade forever, a complete swing trading strategy that works for both beginners and intermediate traders. I know swing trading can feel overwhelming when you're just starting out. You hear terms like moving averages, support, resistance, risk management, and sometimes it feels like you need a PhD just to place a trade. But I promise you, by the end of this video, you'll walk away with a step-by-step framework you can start applying immediately. This video is going to be packed, so grab a notebook because I'll be covering what swing trading really is and why it works, the exact steps to finding winning setups, key indicators and chart patterns that matter most, risk management strategies to protect your account, and I'll even show you a live example of how I personally enter, scale, and exit a swing. And listen, if you watch all the way through, I've got a surprise at the end for those serious about leveling up their trading, so stick around because you do not want to miss it. So let's start with what is swing trading. Swing trading is simply holding a position for more than one day, usually anywhere from a few days to a few weeks. Unlike day traders who needs to be glued to the screen, swing traders focus on catching the bigger moves that play out over time. Think of it like surfing. Day traders are trying to ride every little wave. Swing traders, we wait for the big wave, the one that can carry us further with less effort. The beauty of swing trading is that it gives you more time to analyze, more time to plan, and more time to let trades work out without the pressure of intraday noise. This is why it's perfect for beginners and people who have jobs or school but still want to trade. So why swing trading works? Swing trading works because the market moves in cycles. No stock goes straight up forever and no stock goes straight down forever. Stocks move in waves, uptrends, pullbacks, consolidation, and reversals. Institution and big money don't buy everything at once. They accumulate over time, which then creates opportunity for us to jump in before the next wave. By identifying these cycles, we put ourselves on the same side as the big money, not fighting against it. Now let's talk about how to actually find swing setups. The first step is identifying trend direction. Use the daily chart and the weekly chart just to see where the stock is headed. If the overall trend is up, we look for dips to buy. If the overall trend is down, we look for pops to short. Now the roadmap is support and resistance levels. These are the price zones where stocks historically react. Draw them out. If a stock is approaching strong support, that's where you look for entries. Volume is key. If a stock is moving without volume, the move isn't trustworthy. I always want to see increased volume when a breakout or bounce is happening. For an example, if a stock like JD is trending upward and consolidating near a demand zone, I'll be patient and wait for volume confirmation before scaling in. Now, this is where a lot of traders mess up. Let's talk about indicators. I don't want you to clutter your screen with 15 indicators like most people do. You'll only confuse yourself. Instead, focus on a few that actually work with swing trading. And to start off, that is moving averages, rather the 20-day or the 50-day. Moving averages are like the heartbeat of the stock. They show us the trend over time. 20-day moving averages is short term. This line tracks the recent trend. It reacts quickly to price moves and helps you see the short-term momentum. If price is above the 20-day, the stock is in a healthy uptrend short term. If price keeps bouncing off the 20-day and holding, that's strong bullish confirmation. So imagine a stock like Apple. It's been riding its 20-day line for weeks, bouncing off it like a trampoline. Every time it taps that moving averages, buy or step in. That's your cue. You don't want to chase highs. You wait for those pullbacks into moving averages and then swing it higher. Now, the next one I want to talk about is MACD. That is moving average convergent divergent. The MACD is all about momentum shifts. It shows when a trend is losing steam and when a new one might be starting. The MACD line is basically the difference between two moving averages, the 12-day and the 26-day. The signal line is a 9-day average on the MACD line. The histogram shows the distance between the two lines. So I'll break it down of how to use it for swing trading. Bullish crossover: when the MACD line crosses above the signal line, it signals momentum shifting to the upside. Great confirmation to enter a swing personally. For a bearish crossover, when the MACD line crosses below the signal line, momentum is fading. That is pretty much time to be cautious. And just a note, combine MACD with support and resistance. If a bullish MACD crossover happens right as the stock bounces off support, that's a high probability swing entry. The next on the list is RSI. That's Relative Strength Index. RSI measures speed and strength of price movements. It tells you if a stock is overbought or oversold. So in simple forms, RSI ranges from 0 to 100. Above 70, that means it's overbought, which means it's likely due for a pullback. Below 30, it's oversold and is likely due for a bounce. So how to use it for swing trading. In a strong uptrend, RSI will often pull back to the 40 to 50 zone before bouncing. This is where I like to scale into swings. In a downtrend, RSI bounces into the 60 zone, often acts as a rejection point, which is great for short entries. As a big reminder, indicators are tools, not crystal balls. Moving averages show you the trend, MACD show you the momentum shift, and RSI shows you conditions, overbought or oversold. But here's the truth, price action always comes first. If a stock is bouncing off demand, consolidating near support, and volume spiking, that's your bread and butter. The indicators, they're just confirmation, not the reason you trade. Now let's talk about what a lot of people that start trading confuse themselves with and have major issues with, and that is entry and scaling. Entries are where most traders mess up, and honestly, it's not even about skill, it's about trading psychology. Beginners try to catch the exact bottom because they want to feel like they sniped the perfect trade, which doesn't make sense. But here's the truth. Catching the exact bottom is pure gambling. You might get lucky once or twice, but over time, that mindset blows up accounts. Intermediate traders often struggle with the opposite problem. They wait too long for confirmation, and by the time they enter, half the move is already gone. They buy late, then they panic on the first pullback. The solution is not about being perfect. It's about using a structured entry strategy that reduces risk while giving you room to profit. Instead of trying to nail the bottom, I personally scale in. Think of it like dollar cost averaging, but with a little precision. Now, let's just say this stock is holding this $30 level. I'll enter small around this $30 to $31 level. This is my test position. I'm not all in. I'm just putting skin in the game to see if the stock reacts at this current level. If it retests $30 and holds with strong candles or volume, I'll add more shares or contracts. This tells me the support is real, not just a fake bounce. If price then pushes through resistance, let's just say $35, that's my green light to size up fully. At this point, I have confirmation the trade is moving in my direction. By scaling like this, I reduce risk because I'm never going all in blind. I'm letting the market prove itself before I fully commit. Think of it like building a house. You have the foundation, that's your starter entry, small, sturdy, cautious. You have the framing, that's adding when support proves itself. You're building on something solid. Then you have the finishing floors, that's sizing up on breakout confirmation. Now you can put weight on it because the structure is strong. If you try to build the house all at once, dumping all your money in at the bottom, chances are it will collapse when the market tests you. But if you build in layers, you can handle volatility without breaking. So for my personal entry triggers that I use, when I'm looking for entries, I want confirmation. So here's a few specific triggers I look for before scaling in heavier. You have candle reversal patterns, rather that's hammer candles, engulfing candles, or dojis as support. You have volume spikes at demand zones. That's if volume confirms. That means real buyers are stepping in. You have indicators, RSI pulling back into the 40 to 50 zone like I explained earlier, or MACD curling bullish at support. Another one would be retest and hold. If the stock retests a level multiple times and doesn't break down, that is considered strength, at least in my eyes. One trigger by itself doesn't mean much, but when I see 2 to 3 of what I just mentioned line up, that's when I add size. So now let's talk about scaling. Let's just say I have $10,000. I start with $2,500 near support. If it retests and holds, I'll add another $2,500. If it breaks out with volume, I commit the remaining $5,000. Now, if I'm wrong and the stock breaks down immediately, I only lose on that first $2,500 starter, not the entire $10,000. That's how you protect yourself and stay in the game long enough to catch the big wins. I cannot stress enough that there's so many people that DM me daily, weekly, that said they put all of their portfolio into one stock What should they do? They're panicking. And that is why you need to understand the skill of scaling in. Entries are not about ego. They're not about being perfect. They're about putting yourself in the best position possible to win big while risking small. If you shift your mindset from I need to catch the bottom to I need to build a strong position, your entire trading career changes. You stop forcing trades, you stop panicking, and you start trading like a professional. Why exits are just as important as entries? Let me say this loud and clear. Your exits matters just as much, if not more, than your entry. You can have the perfect setup, perfect entry, perfect timing, but if you don't know when to exit, you'll either cut profits too early and leave money on the table, hold too long and turn a winner into a loser. Most beginners fall into these last two categories. They panic at the first red candle and sell too early. They get greedy, refuse to lock profits, and ride it all the way back down. The solution is a stage exit strategy based on logic, not emotion. I don't exit all at once. I scale out just like I scale in. So here's how I do it in 3 phases. For my first target, I would consider this partial profit, 30 to 50%. As soon as I'm up 30 to 40% on a swing and it's approaching a short-term resistance, I start to trim. This first trim pays me for being right and takes pressure off the rest of the trade. Even if the stock pulls back, I already locked in a good amount of money. My second target is midterm resistance. That's the 20 to 30% range. If the stock breaks that first resistance, I'll hold the next chunk towards a bigger target zone, maybe a gap fill or higher resistance from the daily chart. I keep this part running as long as the trend structure stays intact. And for my final exit, the last piece I let ride with a trailing stop, or I exit if I see a breakdown below key support or a shift in momentum. This is where the biggest profits come from, letting a winner work. By exiting in stages, I reduce regret. If the trade reverses, I already paid myself. If it runs, I'm still in the game. So let's just say I enter a swing at $30 and I'm targeting $50 and I'm using $10,000 in capital. At 38, I trim 40% of my position. That's $4,000 off the table. At $45, I'll trim another 30%, locking in another $3,000. I let the final 30% ride with a trailing stop just under $42. If the stock rips to 55, I win. If it reverses at 45, I still win. That's how you protect profits without missing big upside. Before I wrap this up, if you're serious about swing trading, do not forget that me and the family are doing this every single day inside the Discord. In there, I post my exact entries and exits on every swing I take. And here's the best part. When you first join, you're not just thrown into chaos. You'll get access to a beginner's guide that helps you navigate the Discord step by step. You'll also see a channel where I swing small caps. I know a lot of you guys like small caps. A channel where I swing option trades, and a full market education category where you'll find a free trading course, a dedicated channel to help beginners understand options better, educational tips, and tons of videos that break down strategies you can personally learn from. The truth is, you do not have to trade alone when you've got a whole community right behind you. So if you want to join us, check the link in the description. And if you guys want part 2 of the series, let's get this video to 100 likes. That's it for today, guys. I'll see you guys in the next video.